नमस्कार दोस्तों। हर संडे की तरह आज भी हमारे साथ धनंजय जी गोखले चार्टर्ड अकाउंटेंट है और बहुत सारे बैंकों को सलाह देते हैं, अलग अलग कमिटियों पे काम करते हैं, इंस्टीट्यूट का भी रोल है। हमारे साथ आज जुड़ चुके हैं। वो जुड़ने की वजह भी यही है, दिस इज एन अनशेड्यूल्ड प्रोग्राम फॉर द सब्सक्राइबर्स ऑफ दिस पर्टिकुलर चैनल। आप जानते हैं कि हर संडे में आपको कुछ ना कुछ देने की कोशिश करता हूँ। दिस इज वन सच संडे। I have invited hurriedly Dhananjay Ji Gokhale for a simple reason that on 24th of February, Reserve Bank of India came out with rationalization of Prudential Norms for urban cooperative banks. अब ये जो रैशनलाइजेशन का सर्कुलर जो आया है ना, इसमें बहुत सारा कंफ्यूजन पूरे इंडस्ट्री में हो चुका है और देयर आर लॉट ऑफ बैंक्स हु आर एट देयर विट्स एंड because the implementation of the circular has to be done with immediate effect. For us, the immediate effect is on 31st of March. What will happen on 31st of March? That is the key question which has been asked to me by several bankers. So we would like to understand what the banks should be doing as far as this particular circular is concerned. What are the advantages? We'll go seriatim, point by point we will go. And after each point, I'll request Dhananjay Gokhale to take a halt so that before moving to the second question, we will have the questions which the industry is facing. Remember, friends, this particular circular was issued for reduction of concentration risk, reducing exposure to sensitive sectors, and enhancing provisioning requirements to relatively riskier exposures. Now, yet under these three heads, the Reserve Bank of India has issued these guidelines. These guidelines, by and large, contain only 3 or 4 paragraphs, major paragraphs, and these 3 or 4 major paragraphs virtually is likely to change your balance sheet from this side to the other side, how you interpret that correctly. Therefore, we are here to help you in appropriate interpretation so that you do not make mistakes. And if at all there are spillovers due to some modifications in these exposure norms for particular sector, we'll be asking Dhananjay what is the way out. Normally, the way out is go back to Reserve Bank of India, make a representation, that kind of thing is there. But if at all there is any other thing which Mr. Gokhale can suggest, we would like to do that. Uh, नमस्कार धनंजय जी, आप हमारे शो
नमस्ते।
में पधारे। बहुत बहुत शुक्रिया आपका। आपका व्यस्त समय में आप व्यस्तता में आपने समय निकाला। पूरी इंडस्ट्री आपकी इस सब्जेक्ट के ऊपर राह देख रही है और वो जानना चाहती है कि हम इसको किस तरह से इंटरप्रेट करेंगे। मैं 2 चीजें चाहूंगा। What was the original guideline prior to issuance of this circular and what has happened now? That should be the focus of our discussion that will enable the industry to understand and interpret it correctly. So, floor is yours, Dhananjay ji. Please go ahead.
Yeah. So first of all, thanks for inviting me to share the knowledge, and it's always pleasure to interact with you, even though in virtual mode. So as far as this circular is concerned, this circular is very concise in size and it is very pinpointed in the sense the subject matter is very clear. What RBI is trying to do is that at certain instances, RBI has liberalized certain component about exposures which a UCB can take. And at the same time, at certain instances or certain sectors, I should say, they are trying to ensure that UCBs do not take any excessive exposure. In the sense, they are trying to curtail certain exposures. So we'll go one by one, as per the circular. So let's start with the first para actually, that is para A, which talks about the small value loans. Now, as far as small value loans are concerned, as all of us are aware about that, there was a glide path which was provided, wherein at least 50% of the bank's exposure was supposed to be in the form of small value loans. Now, the definition of small value loans was, set in such a way that it will be 0.2% of Tier 1 capital of the bank or rupees 25 lakhs, whichever is higher. And the maximum cap was set at 1 crore. Now, here
Dhananjay,
RBI has made a
just a
yeah,
moment, just a minute.
sure, sure, sir.
माझ्याकडे काहीतरी प्रॉब्लेम झालाय, मी एक्झिटच झालोय त्यातनं. तुला मी दिसतोय?
Oh, of course.
आय कॅनॉट सी यू.
परत देऊ, नवीन लिंक करू?
हो, मला हे समजतच नाही. आय कॅनॉट सी यू, आय कॅनॉट I don't know what has happened.
ऐकू येतंय? ऐकू येतंय?
तुम्ही बोलतोय ते ऐकू येते, कबूल आहे. पण मला
हा.
somehow I am unable to.
नवीन करतो
एक
ना.
एक एक-
नवीन झूम लिंक. नवीन
नाही नाही
झूम
नाही
लिंक
नाही, आलं
सिंपल.
आलं आलं. आलं मतलब मी एडिट करून टाकेन, हा हा पीस एडिट करून टाकेन.
Okay.
या.
So we will start para by para as far as 24th February 2025 circular is concerned. As far as this circular is concerned, it's very crystal clear circular wherein at certain instances RBI has given a relaxation to UCBs in the form of increased exposure norms. And at specific instances or specific type of exposure, the RBI is trying to curtail that exposure. In the sense, kind of protection which RBI wants to have for UCB sector from taking overexposure to certain areas. So we'll go para by para. The
Yeah.
first para, that is para A, it talks about small value loans. Now, as far as small value loans are concerned, as all of us are aware about that, there is a glide path provided to all the banks, wherein out of total loan portfolio, every UCB is required to achieve 50% target, wherein that will comprise of small value loans. And the definition of small value loans, which was earlier given, was 0.2% of Tier 1 capital or rupees 25 lakhs, whichever is higher. And that was having a upper cap of 1 crore per borrower. Now, this glide path was to be achieved by 31st March 2026. So that is next year.
Original guidelines was for 24. Subsequently, it was
Yeah,
extended to 26. But the advantage is
precisely.
now the size wise they have gone up because banks like Saraswat
Yeah,
and Chamrao were facing
yeah.
huge difficulty in compliance of that particular exposure.
Yeah, actually, they have given the relaxation in two forms. It's not only for larger banks, even for smaller
Yeah,
banks, they have given kind of
yeah,
a
yeah, yeah,
relaxation,
yeah.
wherein they have increased that 0.2% of Tier 1 capital to
Very
0.4%. So
true.
it's almost
Very
doubled.
true. Very true.
Now, because of that, what will happen is that upper ceiling of 25 lakhs in certain cases, which was kind of getting capped actually, so that will also get increased. And the higher cap, which is more predominantly applicable for larger cooperative sector banks, that 1 crore limit has been raised to 3 crores. Now, the moment this limit is raised, actually, it will become effective from the date of issuance of circular. So, any loan which was even sanctioned and disbursed prior to this circular, even that will get counted for these small value loans. So, it's not only loans which are sanctioned after this particular date will be covered under this, but any loan, just to take an example, let's presume that we have a upper ceiling of 3 crores, which is made by a large cooperative bank. And earlier, a loan which is having exposure of 2 crores, which was naturally not getting covered under this guideline, will now get covered. So to achieve the target of 50%, it will be a kind of a relief actually, that you can go up to
So
3
all
crores.
existing loans in the books of the bank can
Yeah,
be covered under these revised instructions, right?
yeah,
It is
that's
not
right.
something from this date it will be applicable, nothing like that.
Not at all. It's
Okay.
immediately effective. So on that date, whatever is the position, we need to verify that in terms of 25 lakhs or 0.4%, whichever is higher, subject to ceiling of 3 crores. So that is immediately effective. So by March 25, that will be a kind of a relief, for most of the banks because of
So
increase
the
in the
banks
limit.
per se must reassess their position, recalculate,
Yeah,
and see where they are standing, and then work towards this objective by March 26. Because
yeah,
possibly
precisely.
they will not give any other additional relief in this because they have already extended it by 2 years.
Yeah,
And now
yeah,
with the additional relaxation, Reserve Bank of India could be not in any mood to reconsider the particular aspect of
yeah,
size. So they will continue to focus on small size. Now, small size has been increased to 3 crores. Of course, this is
yeah,
for the T3 and T4 banks. But then this is
yeah,
a substantial relief that banks must rejoice
yeah,
for being
yeah,
given by Reserve Bank of India. Sir,
precisely. Now, the next para B, that is something which is little ticklish, means in the sense it's a carrot and stick approach, wherein on one hand there is a relaxation which is given from with respect to housing loan. On the other hand, the exposure is capped. So we'll go one by one. So
yeah.
first thing is that we'll first look at what was the exposure cap which was put in earlier. So the earlier cap was that the existing guidelines were specifying that the aggregate exposure of a UCB to housing, real estate, and commercial real estate loan, it was capped at 10% of total assets. So the wordings was 10% of total asset, and that 10% ceiling a bank can exceed by additional 5% of total assets only for the purpose of granting housing loans to individual as per the eligibility norms of priority sector classification. So what it meant was, suppose a bank has already reached to a ceiling of 10%, the subsequent component from 10% to 15%, that can be forming part, that was a eligible part, provided that it was a housing loan to individual and it was under priority sector classification. So that was the existing norm. Second part of this para B is that it was about talking about the limits of housing loan. So we'll divide that into two parts. So first, let's focus on exposure cap. Now this 10 plus 5% exposure cap, now it has completely revamped. And as per the new standard, or as per the new exposure norms, there are two things. One is that aggregate exposure of a urban cooperative bank to residential mortgages. And what does that mean is specifically given in brackets, that is housing loans given to individuals other than those eligible for classified as priority sector. Those should not exceed 25% of total loans and advances. So that is one. Second thing is that aggregate exposure of UCBs to real estate sector, excluding housing loan to individuals, will not exceed 5% of total loans and advances. Now let's look at it in both the forms. Now here actually what is important is that firstly the basis on which this percentage are decided, that is completely changed. So instead of total assets, now we have to calculate based on total loans and advances. So that is first major change,
Come down.
which will curtail the basis. Second major change is the exposure is now capped only at 5% with respect to real estate exposures, excluding housing loans given to individuals. So just to put it in other terms, firstly, I need to calculate what is my real estate sector exposure. From that, I have to exclude housing loans given to individuals. The balance is my numerator and denominator is my total loans and advances, which should be within 5%. Second thing is that if you look at para 6, it talks about aggregate exposure of UCB to residential mortgage, that is housing loans to individual. Now there I need to carve out the housing loans which are classified as priority, and the remaining will become my numerator. Denominator will be my total loans and advances, and that should not exceed 25%. So it's completely a change of calculation methodology as compared to earlier part. Now the real challenge will be the earlier norms of 10 plus percent plus 5%. If you compare with this 25% and 5% norm in para 6 and 7, there is a likelihood that there will be a couple of banks who might have been already exceeding these new norms. Because they might have exceeded. Typically not about para 6. I am more talking about para 7. Because para 6 is something, wherein there is not much of a likelihood that wherein someone will exceed 25% of total loan portfolio only in
Correct.
housing sector. That is something which is unusual. If
Yeah.
you look at para 7, there is a high probability that you can have a real estate sector exposure, excluding housing loans to individual. Now there in housing loans to individual, it will be both priority as well as non-priority. There is a likelihood that it can exceed 5%. Now in that case, first thing is that firstly revisit your real estate exposures, verify that whether you have correctly classified those or not. Second thing is that if you are exceeding 5%, the best way is that you have to write a letter to your SSM or to RBI specifying that you are already above 5% cap, but you are no more lending under that particular portfolio. And in a graded manner, you will not change your loan portfolio in any manner, but you will not sanction that. So suppose you have an exposure of say 7% as of today. Gradually, it will come down to 5%, and till the time it is not below 5%, a bank should not sanction any loan in real estate sector, excluding again housing loan to
I
individual.
have a question here, Dhananjay.
Yeah,
For
yeah,
example, this particular exposure is say 7%, that is 2%.
yeah.
So I will have to ensure that that 7% comes down to 5%, right?
That's right.
Now I need to
Yeah,
either give a program within what time it will come,
yeah,
or I have to tell the Reserve Bank of India, whatever the terms with the borrowers that I have done, I cannot
yeah.
address it because they are based on their cash flows. They are based on a particular
Yeah, it's a
repayment program.
contractual
So
agreement.
the
It's a
existing
contractual
repayment
agreement.
program will continue. There will
Yeah,
be no
yeah,
exposure on a real estate unless I am below 5%. As simple
yeah.
as that.
That's right.
Yeah.
So
So I
what a
need to
bank
approach
should,
Reserve Bank of India, even if there is spillover, that is an indication. Look, buddy, you will not be able to grant additional CRE if you are already exceeding 5%. Simple.
yeah,
This
yeah.
will this be treated as a violation of these guidelines?
Not at all. And sir, just one addition, it is not only CRE, they are talking about real estate sector. So any real estate
Therefore, they are
sector
saying that
exposure.
these are sensitive sectors.
Yeah, exactly. So it's
Yeah.
more kind of a curtailment. Now, let me just add a couple of points. A common mistake, or a few common mistakes which might happen. See, many a times it might happen that a cooperative bank is doing a security lending, security-based lending, wherein end use is not monitored. Now, if you look at other RBI circulars about exposure norms, they are very categoric about, suppose, say, a office is purchased by a particular company, wherein cash flows are generated from that office, let's say factory premises, or maybe a professional who is having a office premises, which is purchased for running the business from that premises. And if the repayment is happening out of cash flow generated from that business, that is not considered as real estate exposure. Now it's very easy to say that then all offices and factory premises will not form part of my real estate exposure. But there's a flip side to that. You need to establish on paper with documentary evidence that how the cash flows are generated, when the loan was given, whether that particular business was capable to generate that repayment, related cash flows. Because many times it happens that there are additional cash flows which are there, which may not be exactly from that business. Now, in those cases, it will be difficult to take these kind of loans out of that real estate exposure. So that is point number one. Point number two is that if you are plainly giving a end use by saying that it is for business purpose without specifying that what is the end use, and it's a typically a lab product, which is very popular amongst cooperative sector and not only cooperative actually, in the entire banking industry. Now, loose wording by saying that it is for business purposes doesn't make sense. You need to establish that what was the purpose for that loan, whether it was for maybe say repayment of earlier loans, whether it was for working capital finance, whether it was for withdrawal of capital from the bank from that particular owners or stakeholders. It will entirely depend upon that, and many a times it becomes practically difficult to prove that what was the end use. Now, in that cases, it will be difficult to take these out of real estate exposures. Second thing is that if you look at the exceptions, wherein the real estate exposure should not be counted, exceptions are given in such a way that typically it is for purchase of property and it is not for advance against property, where the RBI is very clear on that. So suppose you have a property already purchased maybe a year back or 2 years back, you take a loan against that, and then you say that now my cash flows are getting generated and treat this as a non-real estate exposure, that will be little tricky. Unless and until you are able to prove that it is genuinely a working capital finance or maybe finance for machinery purchase. So wherein your security comes as an additional kind of a cushion for the bank, but the primary security will remain as a plant and machinery or whatever is the real end use is. Another very prohibitive part is in certain sections, uh, few banks, I should say, it's not a common thing, and I shouldn't be making that kind of a statement also. The purpose of loan is, in the application letter itself is specified as induction of capital in the business. Now that's a very dicey and slippery area. Bank cannot give loan for introduction of capital in the business. So just to take example, suppose there is a director in a private limited company. The director approaches a bank, gives his bungalow as a collateral security or a primary security, takes a loan, introduces funds as a equity share capital in the business. Now, if that is the case, it indirectly means that you are giving a real estate exposure, that too for introduction of equity share capital, which doesn't have income generation capabilities. So that becomes a kind of a murkier area. So, one has to be very careful about loan against property, the end use of that. And my suggestion is that revisit your real estate portfolio, verify that whether it is correctly calculated or not, and then go for that 5% and other caps, because that is something which one has to do as a precautionary measure.
Yeah. See, the housing loan
Now,
limits is nothing to be discussed about. That's as
yeah, it's
plain as
only
that.
increase and it's a kind of a welcome move actually because the banks who are in metro cities or I should say A category cities, they were finding it difficult to take that kind of customers. Like for example, tier 4 UCBs, they are now given a relaxation to give a housing loan to 3 crores. So they can have a pick and choose approach as far as these large exposures are concerned, and they can take their call because earlier it was kind of a scenario wherein practically they were not able to finance for metro city based housing loans. So that's a relaxation which is a welcome move.
There's one more area where Reserve Bank of India is virtually admitting to its earlier mistake of SR provisioning. That particular para that has come. I mean, I personally have given a lot of fight with Reserve Bank of India, and they were not virtually willing to listen. I mean, you and me have done quite a few videos on that. That the SR provisioning when the asset is not in the books of the bank, how you are asking us to provide and all that. At the end of the day, it is the interest of the bank that is the uppermost in the minds of Reserve Bank of India. That is all fine. But that was defying of logic. Now, with this new amendment that has come up, how do you find this and how it will benefit the bank? So that is, you make a first comment on that, then there could be a couple of questions.
Yeah. Sir, firstly, as far as this para 77A is concerned, I have a little different view actually, because RBI is not talking about provisioning norms, they are talking about valuation norms. So I tend to disagree with that provisioning word actually. They have given the methodology of valuation, and that is their prerogative, how to do a valuation and methodology of that. Second thing is that when they have introduced this particular para 77A, probably, the banks were caught off guard, wherein they were not expecting that they will be brought at par with commercial banks, because for commercial banks, this
Almost
guidance was
70 to
there.
100 banks had gone to dogs.
No, no, I understand. I fully understand, what must have happened. I'm just giving a third party perspective wherein I'm not a stakeholder on either of the side, neither regulator
Yeah.
nor the banker side. But that was something, which was more of a valuation related part. And RBI has been little conservative about that. And that's the regulator's view actually. Now, having said that, what they did actually, initially the guidelines were harsh, wherein, in the first year itself, the provisioning was supposed to be done as far as IDR was concerned, because this was valuation norm. So what they did actually, ultimately, maybe based on the analysis of various banks, which they might have done as a regulator, they gave a gliding path. Now, as far as this glide path is concerned, the glide path was given, which was ending in next year, that is March 26. So it was 5 years glide path, wherein the affected banks were supposed to do a provision staggered in a way wherein every year 20% will be the additional provision. Means whatever was additional provision required because of change in rule, the banks were supposed to do that, wherein, every year 20% was supposed to be done for 5 years. Now, one thing I will just like to clarify over here is, as far as these banks were concerned, when 5 years glide path was there, there was one thing which was a kind of a presumption which one should have presumed and adhered to, and I'm presuming that almost all banks have adhered to, that suppose a SR is maturing prior to March 26, naturally 20% glide path will come to an end when the SR is getting matured. In the sense, whatever is the due date of SR. So suppose SR is having a due date of March 24, a bank cannot extend that 20% staggering beyond March 24. So that's a presumption. Now, what RBI has done right now is, for last 2 years, they have given additional 2 years. So now, up to March 24, 60% provision is already done. What has remained is 40%. Now, this 40%, instead of making it 20% every year, that is 20% for March 25, 20% for March 26, there is an extended period of 2 years. So because of that, now every year they have to do a provision of 10%. So
Sorry,
yeah,
I had somebody who was knocking the bell.
yeah. Okay. So I will just repeat from I think para.
Yeah.
Okay. So as far as this glide path was concerned, what RBI had done at that point of time, that instead of having entire impact in the first year, they have stated that whatever is your additional impact for that bank, you have given a permission to stagger it over the next 5 years. So ideally, suppose I'm having additional 100 rupees of provision, I will stagger it in next 5 years. So 20 rupees each will be my impact on my P&L account. So there is a presumption which is there that my security, that is SR, is not maturing before March 26. Because if it is maturing prior to that, you have to make 100% provision, by that time. Now, another thing which RBI has done right now as a kind of a relaxation is, till March 24, 3 years are already completed. So 60% provision is already made. What has remained is only 40%. In 40%, they have given additional 2 years.
Not
So
in 100%.
not in 100%. So
Uh-huh.
40% has to be divided in 4 years as a prudent practice.
Okay.
One can make a arithmetical argument by saying that now it is 7 years, so I will do 100 by 7 and that thing, but that is something which is not a prudent way. Whatever has been done already, that impact is already there. So you have to
But they
presume that for
have used
the
one word
40%.
that whatever that you have
Yeah,
done is done. There is one word
precisely.
used in that paragraph.
Yeah.
Yeah.
I'm having only one doubt, in this entire relaxation, that initially it was 5 years, now it is additional 2 years, 7 years. So ideally, most of the banks would have exhausted that expiry date of SR. So I'm little, skeptical about how many banks will be there who will be really having that extended period of additional 2 years, because it is 5 plus 2, 7 years. And typically, most of the SRs have a
Very
period of
few
5 years
banks.
plus 3 years. So
Very
only
few
8 years
banks.
is the
Very few
maximum period.
banks.
Yeah. Yeah. So those will get benefited. But for as far as rest of the banks are concerned, they have to end that entire provisioning whenever the expiry date of SR is there, and they should not extend beyond that expiry date. That is something which is misinterpreting the RBI circular. And I'm pretty sure that none of the UCBs are doing that. But extension is, it's a kind of a relief for many banks. So maybe 10% is
It's a big sum. In
good point
case
over
of
here.
bigger banks, it's a big sum.
Yeah. That's true, but then those SR should be there after 2019, because earlier SR
Yeah,
must have already completed 8 years.
I just at times wonder. Here is the government of India which wants all the commercial bank circular to be extended to cooperative banks. But then they are not in a position to really implement it everywhere. In the sense that this is one particular circular, and there are several. I can name at least 25 circulars where the injustice has been done on urban cooperative banks. But so be it. We live with that. There is no point in fighting with Reserve Bank of India, because any issue you take up with Reserve Bank of India, they take 2 years to give you decision. This is the truth of life. Since this is a private channel, I can bluntly and boldly say that some of my RBI friends may not like it, but they're taking too much time on decisions. For example, this SR, had they given this 2 year earlier, the at least 100 cooperative banks financial position would have been different. But चलो रात गई बात गई, अब क्या कहें, हम किसी को कुछ कह नहीं सकते.
Yeah.
I mean, this is my
Just
view on this. I mean, okay, there is a joy, but the joy is filled with a lot of tears.
Yeah, that's right actually, and uh, means I can understand the views which you are expressing, but ultimately it's regulator's prerogative, and I will
Not a
just put one
banker, so
more.
that I can talk more bluntly.
Yeah, but
मेरे
only
किसी
only
को
one
कोई
thing.
तकलीफ नहीं होगी मैं कुछ बोल गया तो.
No, no. But I will just like to add one more point. See, when UCB, the entire sector is saying that treat us at par with commercial banks, it's a kind of a bitter pill which first has to be swallowed and digested. That there are certain things, wherein you have to face a stricter regulatory regime, stricter accounting norms, and this might be just a beginning actually. So there might be more to come, either in the form of relaxation or otherwise. I will give another example, even though it's slightly deviating from the subject. For example, revaluation reserve. Initially, it was given as Tier 1 capital relaxation to commercial banks in March 16 as a part of Basel 3 norms. And Basel 3 still doesn't apply to UCBs, but still UCBs got that benefit. So gradually, it's both actually. There are positives and there are negatives. So
I mean,
uh,
we can keep on arguing on that. I agree with
yeah,
you.
yeah, yeah,
Okay.
right.
So,
Now,
Dhananjay ji,
after this,
uh,
actually, there are two circulars which have been given. So one has to be little particular about, especially the second circular, 26 April 2012 circular, which has been repealed now. That is a circular which was talking about 10 plus 5. So
yeah,
that is completely revamped, and now it is 25 and 5, which is para 6 and para 7. My
yeah,
one more suggestion is that most of the banks must be in the process of reviewing their policies, loan policies and exposure policies and credit policies. So they need to ensure that the effect of this circular is well incorporated. If you have
yeah.
already policy which is already documented, it's better to again revisit that and review it once again, because your next financial year
Take a
entirely will
period
depend
of
upon.
policy review for the next year also, na? So many
Yeah,
banks do that.
exactly, exactly.
Yeah.
So
Anyway,
the circular is short and sweet actually. I don't
Yeah,
see
yeah,
much
yeah,
of a issue. It's a
yeah,
relaxation
yeah, yeah.
except for the CRE 5% real
Yeah,
estate
yeah.
5% exposure, which
Remember, if
might
there
be a
is a
little,
there is always a point wherein you can take up the matter with Reserve Bank of India and
yeah,
obtain appropriate approvals from them that the spillover will be down in the next 3 years or 4 years.
yeah,
But then that
yeah.
prohibits you from granting additional exposure.
So
You
just
cannot
couple
take
of things
additional.
actually. Just one or two things which I will just like to add because sometimes there are peculiar, queries which might be raised by all the banks. Firstly, there will be instances wherein partially disbursed loan will be there. And second instance is that wherein loan is sanctioned but not disbursed.
Hmm.
Now, what I feel is that as far as partially disbursed loan are concerned, you are already including that in your exposures, wherein you open that account in CBS and there is a staggered, kind of a disbursement which happens. Now, in that case, you have already entered into that exposure. You don't have to worry about that. Second thing is that you have yet to open account in CBS, unfortunately, on that date. And already, all formalities are completed, including your, stamp duty payment, execution of document, but account is not opened. Now, in second case, it's not prudent to directly disburse that loan unless you have specific permission from RBI side
ये
because
वो आरबीआई का
you had
परमिशन 6 महीने आएगा नहीं, ये बैंक मर जाएगा तब तक.
it's not about bank actually, it's about the borrower. So bank has to
Yeah, but
ensure
then,
that
there is no point in asking Reserve Bank of India to give you this in within 90 days.
then
They
bank
don't
no, no,
follow
then
these
bank should
norms.
not
They are meant for the
bank
public.
yeah, but then bank shouldn't disburse that because it might be considered as a violation because you are aware that the exposure is not
Partial
allowed and you are
disbursement,
taking
they should
exposure.
write to them. If you are
Yeah,
not disbursed, the better way is to shut the case.
precisely, precisely.
Yeah, that is a
That's
safe
right.
option.
Yeah,
If you are
I agree.
sanctioned but you are full with the exposure,
Yeah,
don't entertain. borrower के पैर पकड़ लो. This is what the story is
yeah,
और मैटर बंद करो. क्योंकि
yeah.
आप
That's a
borrower को
practical
उल्लू
way.
बनाओगे, मैं आरबीआई को लिखता हूँ, ये करता हूँ, उससे कुछ नहीं होने वाला. टेक माय वर्ड,
Yeah,
दे विल
yeah,
नॉट अलाउ यू टू do that because this is
yeah,
rationalization of norms. They will not need to do
yeah.
that.
That's right.
As
That's right.
simple as that.
And it cannot be on case to case basis. So
Yeah, yeah,
that
yeah,
may
yeah.
not be possible
Absolutely
also.
true. Absolutely.
Yeah,
Regulator cannot do favoritism at any
yeah,
point of
yeah.
time. उसको है ना सब घोड़े 12 टक्के, यानी all banks equal as
No,
far
no,
as regulation is concerned.
that's how that it has to be non-discriminatory. So that's how it
Yeah,
has to be.
yeah. Very true.
Yeah,
Very true. Dhananjay ji, thank you for your clarification on this subject. I am sure there would be a lot of questions. If at all there are any questions, you can ask. There is an email ID which I can escalate to Dhananjay ji
sure.
Gokhale wherever it is possible for me to respond to your queries. I'll do that.
Yeah,
But then both of us are open for any difficulty that you might face. Thank you,
yeah,
sir. Thank you for
yeah.
joining. Thank you very
Thank
much.
thank you very
Bye.
much. Thank you. Thank you.
Bye.